$90 a share, down to 26 cents. $60 billion in market value, gone. 15,000 employees watching their retirement savings vanish in a matter of weeks. It was, at that moment, the largest corporate bankruptcy in American history. And here's the part nobody could explain. This was Enron, for years celebrated as one of the most innovative companies in America, the darling of Wall Street, the stock every fund manager loved. So how did one of the most admired companies in America fake it all and fool everyone watching? To understand how, you have to go back to a magic trick hiding in plain sight. Because Enron's collapse wasn't bad luck. It wasn't a single rogue trader or a market crash that caught them off guard. It was engineered. Underneath the world's most admired energy company sat two accounting techniques, not hidden in some basement, but disclosed, blessed by regulators, and signed off by one of the most respected auditors on earth. One let Enron conjure profit out of promises. The other let it make billions in debt simply disappear. Once you see both tricks, the whole empire stops looking innovative and starts looking inevitable. So let's start with how Enron got the power to perform them. In 1985, two pipeline companies, Houston Natural Gas and Internorth, merged to create Enron. At the top was Kenneth Lay, a former economist who took over as CEO. On paper, Enron was boring, steel pipes moving natural gas across the country. But Lay had bigger ambitions, and around 1990, he recruited a McKinsey consultant named Jeffrey Skilling. Skilling had an idea that would change everything. Why should Enron just ship gas when it could trade it? He built what he called the gas bank, turning long-term energy supply into financial contracts that could be bought, sold, and speculated on like any Wall Street security. Enron would sit in the middle, matching buyers and sellers, promising stable prices for years to come. It worked. Enron stopped thinking of itself as a pipeline company and started thinking of itself as a trading house. But trading houses are judged by profits, and that's where the first trick comes in. In January 1992, the SEC told Enron it would not object to something called mark-to-market accounting for its long-term gas contracts. Sounds technical. The consequences were enormous. Normally, a company books profit as the money actually comes in. Mark-to-market let Enron do something else entirely. The moment it signed a 20-year energy deal, it could estimate the total future profit from that contract across 2 decades and book the present value of all of it as income today, right now, before a single dollar changed hands. But here's the problem. For a 20-year power contract, there is no market price, no ticker, no quote. So, fair value came from Enron's own internal models, assumptions Enron itself chose. Optimistic assumptions meant bigger profits, and bigger profits meant a higher stock price. Worse, once a deal's profit was booked, it couldn't be booked again. So to keep earnings growing, Enron had to keep signing ever larger deals. And when a deal went bad, the loss never seemed to show up. Earnings and actual cash were drifting apart, and that gap had to be hidden somewhere. That somewhere was the second trick. Enter the Chief Financial Officer, Andrew Fastow. If mark-to-market manufactured profit, Fastow's job was to manufacture the illusion that the balance sheet was healthy. He built a web of what are called special purpose entities, separate companies with names like Chuco, LJM, LJM2, and a set of vehicles called the Raptors. On the surface, they were independent partners. In reality, prosecutors later alleged they were controlled by Enron itself. Their purpose was twofold. First, to take Enron's debt and underperforming assets off its books, so the company looked far less leveraged than it really was. Second, to act as the other side of hedges, deals that supposedly protected Enron from losses, but were really just Enron insuring itself with its own money. And according to the charges he later pleaded guilty to, Fastow sat on both sides of some of these deals. profiting personally while doing it. The auditor reviewing all of this was Arthur Andersen, one of the most prestigious accounting firms in the world. Andersen signed off. But Andersen wasn't only Enron's auditor. He was also a paid consultant, collecting large fees from the very company it was supposed to police. For years, almost no one asked the obvious question. Then a few people did. The first crack came not from a regulator, but from a reporter. In September 2000, Wall Street Journal writer Jonathan Weil questioned how energy traders like Enron booked profits on deals that hadn't paid off yet. Then, in March 2001, Fortune's Bethany McLean published an article with a deceptively simple title, "Is Enron Overpriced?" She pointed out that for all its soaring stock, no one could quite explain how Enron actually made its money. Around the same time, a short seller named Jim Chanos was building a bet against Enron, focused on a damning detail. For all its reported profits, the company's return on capital was strangely low. The numbers didn't add up. And then came a moment that told you everything. On an April 2001 analyst call, an investor named Richard Grubman pressed Skilling for a basic balance sheet, the kind of document any public company should produce. According to widely reported accounts of the call, Skilling reacted not with an answer, but with a now infamous insult. Think about that. A simple, reasonable question about the company's finances, met with hostility rather than a number. Why would a confident CEO react that way to a balance sheet? Within months, the world would find out. On August 14, 2001, Jeffrey Skilling abruptly resigned as CEO. He had held the job for just 6 months. He cited personal reasons. Ken Lay stepped back in to run the company. To outsiders, it was puzzling. The architect of Enron's trading empire, walking away at the peak. Inside the company, alarm bells were already ringing. That same month, a vice president named Sharon Watkins wrote a memo to Ken Lay. Her warning was blunt. She feared Enron might implode in a wave of accounting scandals. She laid out concerns about the Fasto partnerships, about deals that didn't make sense, about a reckoning coming. She was, in effect, telling the chairman that the whole structure might be built on sand. The question was no longer whether the cracks were real. It was how fast the building would come down. The answer was astonishingly fast. On October 16, 2001, Enron reported a quarterly loss of around $618 million. In the same breath, it disclosed a $1.2 billion reduction in shareholders' equity, tied directly to those Fasto partnerships. The market finally started to see the machinery behind the curtain. The SEC opened an investigation, and as scrutiny intensified, employees at Arthur Andersen began destroying Enron-related documents. Then, on November 8th, Enron did something devastating. It restated its earnings, going back to 1997, admitting it had inflated its income by hundreds of millions of dollars. The profits, it turned out, had never been quite real. A rival energy company, Dinergy, briefly agreed to a rescue merger, even putting over $1 billion into Enron's pipeline business. But as the true scale of the mess emerged, Dinergy walked away on November 28th. With the rescue dead, credit rating agencies cut Enron to junk. That was the final blow, because a trading company runs on its credit. On December 2nd, 2001, Enron filed for Chapter 11 bankruptcy with about $63.4 billion in assets. From McLean's question to total collapse had taken less than a year. But the wreckage didn't stop at Enron's doors. Start with the auditor. Arthur Andersen had once employed roughly 85,000 people across dozens of countries. After it was convicted in 2002 of obstruction of justice over the shredded documents, it simply ceased to exist. One signature on Enron's books had taken down an entire global firm. Years later, in 2005, the Supreme Court unanimously overturned that conviction. But by then, there was nothing left to save. Washington responded fast. In July 2002, Congress passed the Sarbanes-Oxley Act, creating a new accounting oversight board and rewriting the rules for corporate audits. Then came the reckoning for the people at the top. Fasto pleaded guilty, forfeited assets, and turned cooperating witness, and his testimony helped convict the men above him. In May 2006, a Houston jury found Skilling guilty on 19 counts and Lay on all counts against him. Skilling was sentenced to more than 24 years, later reduced on appeal to 14 and released in 2019. Lay never served a day. He died of a heart attack that July, and his convictions were vacated. Shareholders eventually clawed back more than $7 billion. But the number that lingers is smaller and crueler, roughly $1.3 billion in retirement savings, belonging to 15,000 ordinary employees. And no settlement could ever give that back. So what do you take from the rise and fall of one of America's most admired companies? Andrew Fasto himself put it best in talks he gave after his release. "You can," he said, "follow all the rules and still commit fraud." That's the unsettling lesson of Enron. The two tricks at its heart, booking imaginary future profit through mark-to-market and hiding debt in entities it secretly controlled, were disclosed in filings and signed off by auditors. Technically compliant, deeply dishonest. Reported earnings had drifted entirely away from real cash. So here's what to watch for. In any company, in any era. Watch for a business that has to keep signing ever bigger deals just to keep its earnings growing, because that treadmill never stops. Watch for auditors who also collect large consulting fees from the company they're supposed to check. And watch, most of all, for management that meets a simple question about its balance sheet with hostility instead of an answer. When a confident company won't show you the math, the most important number is usually the one they're hiding.